Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Tesla reported earnings last week, and the market didn't seem to like what they saw. There was a couple of things that really stood out to me that are really continuing trends that are troubling for Tesla, especially in an auto market that overall seems to be pretty healthy. We have not seen things like inventories piling up at legacy automakers. We've not seen price reductions, but Tesla's a little bit of a different story. So I want to dig into the results and the concerning trends that I've seen. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with a couple of charts. The first one is the price per vehicle at Tesla. This is just for the automotive segment, and it excludes the electric vehicle credits that the company sometimes has. That's not a revenue source that's going to be sustainable long term, and it's been really lumpy, so we don't know exactly what that's going to be. So that's not a piece of the business that I would rely on long term. But what we have seen is prices coming down really dramatically. Q2 2022, so a year ago, the average price per vehicle that Tesla sold was $57,331. I want to note that that was up nearly $9,000 from Q1 2021. So during the pandemic, when the auto market was in short supply because a lot of automakers couldn't make enough supply because they canceled their chip orders early in the pandemic, when the market was undersupplied, Tesla raised prices. Now that the market is not nearly as undersupplied, what is Tesla doing? They're lowering prices. They're lowering prices at a really rapid rate. In the most recent quarter, the average price of a vehicle sold was $45,626. That is nearly $12,000 lower than it was just a year ago. When an auto company starts lowering prices, starts adding incentives, starts extending the loans that they will offer to consumers, that is a sign that they don't have enough demand for their products. One reaction that automakers can have is actually cut down on their supply. So oftentimes you'll see this. There will be long shutdowns at plants. They talk about them being upgrades, but really what they're trying to do is manage their inventory. Tesla does not do that. They may do that a little bit in the third quarter, as they do have some shutdowns. They're expecting production to be down sequentially in the third quarter. But so far, they have not done that, still targeting about 50% growth in production. And if you're growing that much, you need to have demand grow 50% as well. That doesn't seem to be the case. So what's the only reaction you can have? You can lower prices. Now, one thing I have often seen people talk about is, well, they're getting a lot more efficient with making vehicles, so their cost per vehicle is coming down as well. That is the case, sort of. Over the past year, the cost of producing a vehicle has come down a little bit over $5,000. 42 in the most recent quarter, $37,059 is what it cost to produce one of Tesla's vehicles. The problem is that prices are coming down faster than the costs are coming down. So as a result, what you get is gross margins coming down dramatically. Gross margins peaked in Q1 2022 at $15,675, now down to $8,167, a gross margin of 17.9%. This is now a level of gross margin that is not all that different than a lot of auto competitors. So a year or two ago, Tesla was talking about how it had margins way better than everybody else in the industry. That's just simply not the case anymore. The problem for Tesla is, what do they do from here? They're going to increase production 50% next year, and the year after that, they have the Cybertruck ramping up, but we don't really know what demand is going to be for that. It seems like for now, we're going to have the Model 3 and Model Y being a vast majority of the company's production, and those vehicles are getting pretty old by auto standards. So Tesla is increasing production at an extremely rapid rate. Demand doesn't seem to be keeping up. They're lowering prices, lowering margin. I just don't know what you do to drum up more demand for an electric vehicle as more competition is coming into the market. The signs are there. The margins are coming down. Discounts are increasing. Tesla is getting more and more desperate to move metal, but the stock has not come down dramatically over the past few months. In fact, it's risen so far in 2023. I think this is a warning sign for investors, especially if there's any sort of slowdown in the economy later this year or into 2024. That could put a massive dent in auto demand overall, not just for Tesla, but for every company. And remember, interest rates have been rising like crazy over the last year and a half. So a lot of headwinds for Tesla, and this is still an incredibly highly valued stock. I would be cautious as an investor. I do not have a position in Tesla stock, but the operating trends do not look good right now. So, what did you think about the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.